Good afternoon, everyone. My name is Chaudhry Mohammad Aziz Anwar. Today, I will present my answer for question 1, which consists of three parts: the after-tax cash flow from an asset disposal, the concept of incremental cash flows, and the factor for deciding whether or not to choose a project. After-tax cash flow from disposal. Northern Company purchased an assets for $50,000 that qualifies for 5-year max depreciation. The depreciation rate for the first 4 years are 20%, 32%, 19.2%, and 11.52%. Adding them gives a cumulative rate of 82.72%. This means the cumulative depreciation after 4 years is $41,360. So the carrying value at the end of 4 years is $8,640. Now, if the company sells the asset for $5,000, there is a loss of $3,640 with a tax with the 20% tax rate. The company gains a tax shield of $728. Therefore, the after-tax cash flow from disposal is $5,728. This example highlights how tax effects and depreciation rules impact final cash flows. Incremental cash flow concept. Incremental cash flow means the difference between the cash flows with the project and without the project. This concept is central to capital budgeting as it isolates the true value a project contributes. Key points include: sunk costs are excluded since they cannot be recovered. Opportunity costs are included as they represent foregone benefits. Working capital adjustments are considered because receivables, payables, and inventories affect real cash. Financing costs are ignored, so the focus stays on project performance, not capital structure. Finally, positive incremental cash flows indicate value creation, while negative flows signal rejections. This framework helps ensure managers base decisions on relevant and future-oriented data. Factors for project selection. When deciding whether to accept or reject a project, several factors must be assessed. Net present value. If NPV is positive, the project creates shareholder value. Internal rate of return (IRR) should exceed the cost of capital. Payback period, useful for managers focused on liquidity and quick recovery. Risk analysis. Sensitivity or scenario analysis help understand how results change under uncertainty. Timing of cash flows. Earlier inflows are more valuable due to the time value of money. External environment. Taxes, inflations, and political stability affect long-term outcomes. Opportunity cost of capital. Projects should be compared with other alternatives to ensure resources are optimally allocated. This holistic evaluation ensures that a project is not only financially sound, but also strategically aligned. In conclusion, the after-tax disposal cash flow shows the importance of depreciation and tax treatment. Incremental cash flow analysis provide a clear lens to evaluate projects, and decision factors like NPV, IRR, payback, and risk help managers choose wisely. Thank you for listening to my presentation.